Good morning, everybody. Welcome to another Daily Market Report brought to you by Mike Bjork. Today is Tuesday, March 31st. We got end of the month as well as end of the first quarter, so it'll be interesting once we go into next month. We'll see the GDP for the first quarter. We do got a few economic data to kind of over today. Let's kind of jump right into it. We'll start off with the Case-Shiller Home Price Index. This is the national level, and they had back in December a 3.7% year-over-year appreciation, and it jumped up to 3.9%. So we've been kind of seeing an improvement with the home price index. However, this is January, so we've started having this crisis and change in the market starting middle of March. So it'll be interesting to see once we get kind of March and April data what we're seeing in that case. So it'll be uh, we'll kind of have to watch and see, basically wait and see approach with those things. We do expect it maybe kind of dip a little bit as there'll be less activity out there. However, we do still with the low inventory, we do still see people out there buying and stuff. So, in any sense, let's kind of move on here. We got the manufacturing in the Chicago region with the Chicago PMI in March. We had a 49 with the previous report in February, which was went into contraction period. It's still in contraction. Anything below 50 on these indexes, contraction. Anything above is expansion, and it dipped down to 47.8. However, this is beating expectations because with the whole coronavirus things and everything else, that kind of almost came to a complete 180 in terms of where the economy was moving. They were thinking it could be low anywhere between like 35 and 40. So this is a much better gauge of what they forecasted. So the markets are pretty happy about that. Same thing with consumer confidence. When you see 132.6 in February, which was a very high number, they were figuring it dropped down to 115. Still came in a little better at 120. Uh, People are still feeling pretty good in March, but we'll have to kind of watch and see how much of a dip we might see in April numbers as we get deeper and deeper into this coronavirus situation here. Let's kind of move on here to the headline news. Stocks are up this morning. They like that data with the manufacturing that came in a little bit better than expectations. Also, Chinese manufacturing showed quite a vast improvement in their services and manufacturing. They're down to around 30 on their indexes and jumped just over 50%, 50, and moving in expansion territory. And the numbers kind of appear to be too good to be true. So there might be some speculation or some critics of that data, especially considering that China is not fully up and running operationally compared to the pre-crisis situation. So we'll have to kind of wait and see if they're going to have the critics will, but these are the numbers being reported out by China right now. So let's kind of take a look here, see how this has affected the bond market. Bond market was down quite a bit yesterday. We had a price change. We were way up here at 105. Touched off that, dropped. We closed down 66 basis points. We started the morning a little bit higher than we were yesterday, and now we're down about 14 basis points currently right now. So we will have a pricing for the worse. There'll be a little bit worse pricing, but we kind of need this pricing to worsen only because we've got a lot of loans caught in the pipeline, which is artificially keeping prices higher to slow that down due to the mass amount of refinances that came in March. We're trying to get cleared through those. Once they get cleared through those, what's happening is that these are margin calls that are happening, and because the rates are getting better and compared to what the locked rates are, the creditors or the credit lines were asking for cashing on the margin calls. So these lenders are dishing out tens of millions of dollars to cover these margin calls. So as these were getting better, and the rates were getting better and better, uh, it was creating more of a pipeline drag, and it's kind of basically preventing fundings and everything else that's going on with a lot of these lenders. It's hurting their liquidity. So last week was propped up by the Fed. They were buying nearly 40 billion almost every single day, which is what kind of brought this up. Yesterday they were scheduled to buy about 40 billion, but they may have been seeing the results of what's going on in the bank industry. May have heard the pleas to kind of hold off a little bit, and they only bought about 20 billion. So we end up going downwards as a result. So, and then on top of that, we had other traders kind of jumping in, piggybacking off the Fed, figuring that they'll ride the prices go up as the Fed's buying. and then they kind of pulled back on their purchases as the Fed did as well. So they too also kind of pulled back. So we were getting that kind of exacerbating as a result. So if anything, we kind of want this kind of hang tight a little bit until we can get through those pipelines. The sooner we get through the pipelines, the sooner we can try to get better pricing out there and hopefully bring back some of these loan programs like your jumbo and your QM loans and get some improvements in those areas. The other factor that could affect that would be, of course, this whole thing about forbearance and stuff. People not paying their mortgages and stuff like that, or hurting, or job losses, qualifying. This could provide issues for people to qualify for refinances or purchases and stuff if they're not making payments, or they're going ahead and losing their jobs and stuff. So we'll have to wait and see what rolls out from that, if they give any relief in that area. Speaking of forbearance, for those of you who are thinking, because we're getting to that point in the month where people are going to be making a mortgage payment and maybe have heard about the forbearance, this is not a forgiveness program. Just be aware that this is a program that if you're not making your payment, it's going to be, you contact them, you're going to have a long line, because you'll be on the phone for a couple hours just trying to get through, as a lot of people are jumping to this. But be aware that this type of program is not designed as a forgiveness. You will be paying this over at some point or later. And if it's done too much, you could get yourself into a deeper hole than what you could get yourself out of. So just be cautious and really think through this before you jump into doing a forbearance. If you don't have to do it, I recommend not doing it. If you're in dire straits, then you need help. Obviously, that's no question. You need that assistance. But if you don't need to do it, you may want to hold off from doing this, because all you're doing is pushing it back. You're hurting your credit and everything else. So just be a little cautious with this. It's not a forgiveness program. It's not a grant or anything. This is simply a way to structure your mortgage, maybe having to split the payments down the road or repay it later, lump sum. So just be a little cognizant of this. So be careful. All right, so let's jump ahead here to yields. Yields are up a little bit. We're currently at a rate of about 0.69 right now on the yields. So again, we're still in no man's land. It's got a lot of room for either direction to go. And of course, as we mentioned, we want to try to get the mortgage-backed securities down a little bit and raise the rates a little bit, just so we can give a little reprieve to the lenders, so we can get through the pipelines and then get back to some type of normalcy in terms of our pricing. Okay, so hopefully we all can work together and get these things through. Things are a little tough right now for everybody, and everybody's going to be doing their best to try get things moving along and try to get back to normalcy at some point. All right, so speaking of such, if you guys are in California looking to buy a refinance, please reach out. We have a lot of sources out there for a lot of different loan programs, so we do find a few things going on out there. It is ever changing, so people are, as we go, stop doing certain things. We do have a source or two for jumbo, but for how long I can't say, because at some point other people will be going to them funding, and once they fund too many, they might get to a point where they don't have the liquidity to fund anymore. So just a word to the wise out there, to be cautious. And the best way to reach me to go over your scenario is either direct message me or email me. In any case, things will get better. And if you guys want to talk about trying to get something in the future, getting something once this kind of shakes itself out, we'd love to help you guys out. Still, we can talk a little bit and get a feel for what you're looking to do. And once things shake out and get back to the good pricing and stuff like that, we can wait and do that as well. All right, folks, you guys have a great rest of your day. Thanks so much for watching. I look forward to see you guys in tomorrow's video. Bye-bye.